So Kim Lisa Taylor is a syndication attorney. Kim is the founder of Syndication Attorneys PLLC, a corporate securities legal practice. She is a nationally recognized corporate securities attorney, author, and a public speaker, and is licensed in California and Florida. She has been the responsible attorney for over 300 real estate security offerings. Her nationwide practice is focused on helping clients structure their company and legal raise money from private investors under federal and state security laws. That you have a big responsibility.
That's right.
Well, we are honored to have you on, and we can see your screen very well. So go ahead. At the very end, I would like to say, everybody go ahead, and if you have any questions and answers at the very end of this, feel free to go ahead and submit them in the box, and we'll go ahead and get them answered at the very end. This is from 11 to 12:15. So looking forward to your presentation, Kim, and the show is yours.
Thanks a lot, Chris.
All right, you're welcome.
I'm so excited to be here, and I really appreciate that Dan invited me to come. I can tell that, I haven't had a chance to listen to all the panelists, but I did hear Vinny Chopra just a few minutes ago, and he's a hard act to follow, I'll have to say. Vinny is a longtime friend and actually a client of the firm, and we've known each other for 8 or 9 years, and he's definitely one of our more successful syndication clients. And he actually follows the things I'm going to teach you in this particular program. So if you want to be like Vinny and you want to be as successful as Vinny, pay attention to what I'm going to teach you, because I think it's going to help you get there. So we help people who are raising money from private investors stay out of jail. Plain and simple, there's securities laws that apply to what you're doing. They seem to be a little bit complex. They're not as hard as you think, and we're going to walk you through all of that. So the topic that we're talking about today is how to legally market your deals to investors. So there is an illegal way to do it, and there's a legal way to do it. And we're going to help you understand the difference. So this presentation is for information only. There's no guarantees. It's all dependent on what you do that determines your results. So it's totally up to you, and you can't count this as legal advice. We'd love to have you as a client of the firm, but this presentation doesn't constitute that. So if you want to become a client of the firm after listening to the program or at any time, then you can contact us directly and we can set you up with what you need. So there isn't any attorney-client relationship here. Well, that's me. I am a corporate securities attorney. I do have a nationwide practice because almost everything that we do is under federal law, and we're allowed to help people in any state with that. I've been the responsible attorney for over 300 securities offerings. I've been doing this now for 10 years. I've helped investors who have set up offerings for them so that they could raise over $1 billion in equity, and some debt from investors. I too am a real estate investor, actually syndicated a property before. We just recently sold ours, and I have some other investment properties and vacation rentals. I'm also an author. I have a book that's coming out in the next 2 weeks, How to Legally Raise Private Money for Real Estate and Small Business. So I would love to have you all read that. It's really going to be it's going to track a lot of the things that we're talking about here today. So it's just going to go a lot more in depth. Obviously, I can't go that far in depth on a 1-hour program, but I think it would be worthwhile if you want to syndicate, you want to legally raise money, you want to feel, the whole point is that the more you understand the legal aspects of it, the more confident you become when you speak to investors, and they sense it, you sense it, and your business can flourish. So we always have to start with what's your motivation, because you have to really understand what is it that's making you do this. Why do you even want to invest in real estate? Is it, for a lot of people, it's because they want to leave their current job. For other people, they want to have a better retirement. And maybe those two are even the same in some instances. Some people just want to augment their current income. Some people want to actually help their family and friends. They see their family and friends that are struggling with their investments. maybe not making enough in the stock market or don't understand the stock market, so they're afraid to invest. And they have a lot of money sitting in savings, maybe in self-directed IRAs, and it's not earning a return. So if you can tap into that and get to know those people and understand what their goals are, then those are going to become really fantastic investors for you. And your goal is not to have investors for one deal. It's to have investors for life. The really, really successful companies, and I actually was just at an event yesterday at the National Apartment Association, and I met somebody who said, I've got $15 million worth of investors sitting on the sideline, and the same people invest with us again and again and again. And he's like, I'm just, I'm looking for a deal. As soon as I get the next deal, I can fund it. And that's where you want to be ultimately. So think about why you want to do this, and actually do more than that. Write it down and put it somewhere where you're going to look at it every single day. And be as detailed as you want about it. That's what I do. I actually look every single day at where I want this law firm to go, what I'm trying to do to accomplish with it, and how, what are the steps I need to take to get it there. You can do the same thing for your business, and it's really helpful if you just review that every single day, once or twice a day. I learned that from the book Think and Grow Rich. But what is it that's stopping you? For most people, it's that you don't have enough of your own money. And that doesn't mean that you're poor. It just means that everybody doesn't have enough money. Even, Donald Trump, as a real estate investor and highly successful real estate investor, brings investors in on his deals. So no matter how much money you have, whether it's a small amount or a large amount, you still want to learn how to have these skills so that you can bring investors to your deals when you have them, regardless if it's a $1 million deal or a $100 million deal. You still have the same problem. So once you master the skills that I'm talking to you about today, you're going to be in good shape. So what can you do about it? You got to learn to syndicate, but more importantly, you have to learn how to effectively raise money and develop investor relationships and get a pool of investors who are ready, willing, and able to invest with you. Even my most seasoned syndication clients, I've got people that have done many, many deals. And the one thing that they all struggle with is how to have those investors ready and willing and able and ready to go when they have their next deal. And so what happens when you don't have that is that you end up making some compromising decisions. So you might take money from somebody you don't know very well. You might try to hook up with a single investor. A lot of clients, especially new clients, waste a lot of time trying to chase down what I call whale investors. Whales, like the fish, right? Like the, well, I guess it's a mammal. But they chase down whale investors. And the problem with whale investors, I always say this, is you need to think of the movie Moby Dick, or the book, and think about the wake of destruction that was left behind after that whale tore through the boat. Because I've seen that happen again and again to syndicators that try to go that route. Those types of investors, especially when you're new and you don't have a big track record, they will string you along. They'll tell you, oh, we'd do it if you did this, or we'd do it if you did that, but they really won't do it at all. They're just trying to they're too polite to say, no, you don't have enough experience. So, you need to be careful, because they're going to string you along, and then they're going to pull out at the last minute. And if you haven't done something else in the meantime to try to backfill all the money that you were expecting was going to come with them, you're going to be left with a deal that you can't close on. You're going to have to drop out of the deal. You're going to end up losing your due diligence money, maybe the money you paid for legal fees to your real estate attorney, maybe to us. You're going to end up with a big bill that you can't get back. So you don't want to go that route. It's not the ideal route for any new syndicator to go, and it's really only for the people that have been doing it for quite a long time and have a track record and are able to pull in those kinds of investors alongside their own investors. So very rarely do those investors even come in and fund 100% of the deal. They'll still come in and they'll only fund a portion of it. So you've got to raise a portion of it for yourself. So you've got to learn to syndicate. So what is syndication? It's just organizing a group for a common purpose, to promote a common interest or to carry out a particular business transaction. So that's what you're doing when you're syndicating, is whether you're hiring an attorney to help you create a company. That company is going to sell interest to investors. You're going to stay in control of that syndicate because you're the one that found the deal, that took the time to learn how to do this, took the time to learn how to buy the kind of assets that you're buying, and then took the time to learn how to manage those assets. So you want to bring in passive investors, you're syndicating. So it's not as hard as it sounds. Okay, it's like learning to drive. When you're learning to drive, you need three things. You need to learn how to operate the vehicle. You'll need to learn how to understand traffic signs and traffic signals so that you don't crash and burn. And you also need to learn how to navigate. So how do you get from here to there? You know, which route are you going to take to the mall? Are you going to go through the side streets in the neighborhoods, or are you going to get on the highway? Whichever route you pick is going to have a set of rules, and you're going to have to follow those rules. You go through the neighborhood, you got to drive 25. If you're going to go through on the highway, you better drive the speed limit on the highway, or you're going to get in a wreck. So in either of those cases, you've got to learn those three things. Syndication is just like that. You've got three things you have to learn: securities laws and how they apply to your offering. You don't have to learn all the securities laws that are out there. You don't have to learn how to set up an IPO, an initial public offering. You don't have to learn things that aren't relevant to what you're doing. You don't have to learn about stocks and bonds. You just have to learn about the securities laws that apply to what you're doing with your investors, and it's a small subset of securities laws, so it's not that hard for you to figure out. A lot of people do it. You also have to figure out your investment model. What is your business model? What are you investing in? And then you have to figure out how you're going to market your securities to investors and get that deal closed. So start with, what's your business model? That's the fundamental thing that you really have to figure out. Are you starting or growing a business? Maybe it's not even real estate. Or maybe some of you who are investing in real estate have a different idea about something else that you want to do. You can still raise money this way. And raising money from angel investors or venture capital can be a lot like those whale investors that I was talking about. They're going to carve out a lot of your deal. They're going to take a piece of your skin, and maybe more than you'd have to give up if you brought in your own group of investors. So, but most of you who are on this call, and most of our clients, are buying real estate. So then you have to think about, what is it that you're buying? Probably a lot of you, of course, on this particular event, this is the Multifamily Investor Nation, you're buying multifamily properties. But some of you might be looking at other asset classes as well, like self-storage or hotels, retail, office, mixed use, mobile home parks, industrial parks, single family, any type of real estate, vacant land for development. There's certainly other things that aren't on this list, but you need to narrow this down because you can't get good at everything. And if you want to dabble in multiple asset classes, your best course is going to be get really good at one and then transition into another. If you try to go too many different directions, you're not going to be successful, and it's going to be hard for you to build a track record. Because if you want to buy a multifamily property and you go out and you start talking to your investors and they ask you, well, what have you done before? And you say, well, I did 3 self-storage units. They're not going to think that that's not a track record for multifamily. So if you want to do multifamily, you have to do multifamily. I want to caution you also, as a little aside, about joint ventures. So in joint ventures, the difference between securities and joint ventures is, in joint ventures, all of the members are actively involved in generating their own profits. So you're not taking control of their money. You have to be a little careful about doing joint ventures because that doesn't give you a syndication track record either. So you've got to make sure that whatever your business model is and where you want to go, you stay laser focused on that and you get really good at that. And then if you want to start moving into a different direction, a different asset class, then you'd be able to do that, but you're going to have to start again from scratch, the same way you did with your first asset class. So what is your business model? Are you going to buy properties that are existing and add value? Are you going to develop raw land? If you're going to do development and you've never done it before, make sure that you team up with a seasoned developer. because that is, so maybe you can bring in the money and they can bring the deal and they can run the development. And you stay in what they call the GP side or the management side, so that you get to follow along with all the things they're doing in the development, so you can eventually learn the development business, but you don't want to start on the development business up front all by yourself. And I can tell you from my own experience that that is just a really big challenge, and it's fraught with pitfalls that you can't even imagine. So experience counts in development. Make sure you're teaming with an experienced developer before you try that. But that's really true of any kind of syndication either. You can leverage off other people's experience. So if you don't have experience in multifamily, for your first few deals, you might want to go out and team with somebody who does have experience in multifamily, who will put you into their management side. And sure, they're going to want a piece of that deal and maybe a big chunk of that deal, but they're going to help you get that deal done. And you do that 2-3 times, and all of a sudden you're now the experienced syndicator, and you're the one that can go out and start syndicating these deals. And maybe you're bringing in other people without experience that can help you in other ways on your particular project. So when you're thinking about your business model, you also have to think about, okay, now that I know what kind of asset class I want, what size am I talking about? You know, what's your price range? What is your location? What other criteria are you using to determine whether or not you would purchase that particular asset? And these are the things that you need to share with your investors, especially before you have deals. So if you put together your business model so that you have something to talk to your investors about right now, then this is what you talk about. Hey, we're investing in this kind of thing. It's got to be in this, you know, we're looking in this geographic market. We're looking at price ranges from here to here, and maybe units from 50 units plus, or maybe it's 2 to 50 units. You know, whatever your criteria is, you need to have that nailed down, and you can put that into a business plan that you can share with your investors. So you need to have a business plan that it just sets it in stone. And the other reason is it helps keep you on track so that you don't start wavering off track, because it's very easy, especially now when we have a little bit of a tight market in multifamily, it's very easy to start wandering off the beaten path and looking at other shiny objects that might have a better cap rate or might have a better this or that. But you could easily find that the people that would support you in your multifamily business are not going to be supportive of a different asset class. So you've got to be super careful about doing that. And again, if you're going to wander off the beaten path, team up with somebody who's done that particular asset class before, and then see how you can add value to their deal by bringing them something they need. And that way you can develop a track record with that. So we're going to briefly talk about securities laws. Some of you may have already been through some securities laws presentations before. I'm not going to belabor this. I'm just going to, but I feel like in case somebody's on the call that hasn't actually listened to this part of the presentation before, you really need this foundation before we can talk about how you can legally market. So just bear with me for a few minutes. We're going to get through this quickly. I think you're going to find it enjoyable. And then we'll be able to move on to what you need to do to legally market to investors. So the first thing we're going to do is try to play this little video.
What's a security? A security is a legal instrument you sell to private investors in exchange for their money. Securities commonly sold by small businesses and real estate investors include promissory notes and investment contracts. A promissory note is a legal contract you provide to someone who loans you money. It's basically a promise to pay, usually with a remedy if you don't. But what are investment contracts? In 1946, the U.S. Supreme Court defined investment contracts as an investment of money in a common enterprise with an expectation of profits based solely on the efforts of the promoter. If you sell ownership interests in your company to investors who expect to share in the company's profits, you're selling investment contracts, and those are securities. The sale of securities must be registered with the securities regulators unless an exemption applies. Each securities exemption has its own set of rules. That's where we come in. We can help you select and comply with an appropriate exemption for your securities offering.
So I hope that was helpful and a little bit
What's a
entertaining.
security?
Oh, let's see if we can get past that. Okay, there we go. So just to recap, just the highlights. Securities Act of 1933 said that the offer or sale of securities must be registered or exempt from registration. Well, registration means that you have to go through an approval process with the regulatory agencies before you can sell the securities. So that's the IPO process, the initial public offering. A registered offering is the same thing as a public offering. You're not going to do that. The reason you're not going to do that is because it takes too long. It's going to cost a lot of money. It's going to take months and months, and it's not something you can do when you have a project under contract and you have to close in 90 days. It's just not something that you can do at all. So just remember that. So you're going to want to look for an exemption, and this is where we come in, as we can help you comply with that exemption. Let's go back. So what's an investment contract? Just to recap what was in the video. It's an investment of money in a common enterprise with an expectation of profits based solely on the efforts of the promoter. Well, you're the promoter. You're the one who is actually found the deal, looking for the investors, doing the due diligence, coordinating the lender, and all of that. You're going to be the one who's going to be in charge of oversight of property management and eventually selling that asset and sharing profits with investors, both from operations and along the way after you sell the project, when hopefully there's some equity that's realized on the sale. So that's an investment contract. And if you're selling investment contracts, then you have to comply with securities laws, but this is where we're going to look for an exemption. So just to reiterate the kind of examples of securities that apply to you are interest in an LLC, so passive interest in an LLC, and any interest in a managed LLC where the members are providing the cash, limited partnership interests where you have a general partner that's running the project and limited partners that are putting up the cash with limited rights to participate in management, corporate shares or stock where you have officers and directors who are running the show. And so basically it just boils down to any time you have passive investments where your investors aren't actively involved in finding the deal, vetting the deal, running the deal, then that's when you're selling securities. So some typical exemption rules are going to limit, maybe have a dollar limit on the amount of money you can raise. They might limit the number of investors that you can have. They might have certain qualifications for your investors, some financial qualifications they have to meet before they're allowed to invest with you. They're probably going to restrict or even prohibit advertising. So no general solicitation or advertising. You can talk to people word of mouth from your own current network, but you can't go out and advertise all over the internet or any other way. You have to usually disclose the risks of investing. When you're selling securities, you have an obligation to make sure that all of the investors have all the information they need to make informed consent. Informed consent. And that's what comes out of, say, a private placement memorandum or an offering memorandum or an offering circular or a prospectus. All those things basically mean the same thing to you. And that's the place where you describe how the offering is structured, who's running it, and what kind of risks are involved with it. And then there's some securities notice filings. If we're following a federal rule, there's going to be securities notices that have to be filed with the SEC. And then also with the states where your investors claim residency. So there are different exemptions based on federal law, or some are based on state law. So it depends on where the asset is, where you are, and where your investors are, whether you're going to try to follow a state or a federal exemption. If you want to follow a state exemption, then everything has to be contained in one state. You, all of your investors, in the property. Most of the time, we're dealing with clients who are working under federal law, and that is by far the most popular way that people are raising money right now is under the federal regulations. And that's because, like you, They're going to events around the country. They're meeting people from all over the country, maybe even all over the world, who want to invest with them. And they need to be able to follow one set of rules. So if you're following the federal law, then the federal law will preempt the individual state laws. You'll be able to follow one set of rules for all of your investors, and it will make your life much simpler. So investor qualifications, this is where you may have heard the term before, accredited or sophisticated or non-accredited. So the accredited investor rule, I call it the 1-2-3 rule. It's a really simple way for you to remember it. For accredited, they have to have over $1 million net worth, excluding any equity in their primary residence. So $1 million net worth, or if they're single, they have to have over $200,000 income, and in the last 2 years with an expectation it will continue. If they're married, they have to have over $300,000 income. So it's the 1-2-3 rule: $1 million net worth, $200,000 income if single, $300,000 if married. So what's non-accredited? It's everybody else who doesn't meet that definition. In the most popular federal exemption, which we're going to talk about in a moment, everybody also has to be sophisticated. Both your accredited and your non-accredited investors must be sophisticated, and that means that they have to have sufficient knowledge, education, experience to be able to understand the risks and merits of the offering and whether it's appropriate for their portfolio. They have to be able to determine whether they're suitable for that investment, and is that investment suitable for them. Okay, so here's the two most popular federal exemptions. So we have Regulation D, Rule 506 is the main exemption. Back in 2012, there were some changes in securities laws that brought about a subdivision of Rule 506. So now we have Rule 506B and we have Rule 506C. So Rule 506B is where most newer syndicators start out, and I have a lot of clients that have been raising money for a very long time, and they still use Rule 506B. So this is the one you really need to focus on, and if you do, then you're going to be more successful in raising money than you will if you try to jump into Rule 506C for a variety of reasons. So let's really focus on 506B, and then we'll cover the differences. So in Rule 506B, you can raise an unlimited amount of money from an unlimited number of accredited investors and up to 35 non-accredited investors. But remember, all of your investors still have to be sophisticated. So they have to have more than just a job, with some savings. They have to have gone through some training or coursework, or maybe they have a business or finance degree, or have heavily invested in real estate before. Maybe they're even heavily invested in the stock market. One of the reasons self-directed IRA companies train their clientele all the time is so they become sophisticated investors so they can invest in deals with you. So that's something, just a little tidbit that you want to keep in mind, because they can be a rich source of potential investors for you if you learn how to market adequately to them. But in the Rule 506B offering, there's absolute prohibition against advertising or general solicitation. So that means, remember when we said that the securities laws govern the offer or sale of securities? Well, this no advertising rule says in Rule 506B that you can't make offers or sales of securities to anybody that you don't already have a substantive pre-existing relationship with prior to making the offer. So you have to have a pre-existing substantive relationship, and we're going to get to what that means in just a moment. But let's cover Rule 506C before we leave this slide. So on Rule 506C, still can raise an unlimited amount of money. And I will tell you that for 506B, there are hedge funds that are using this exemption and raising hundreds of millions, if not billions of dollars. And they still use this Rule 506B. So it's by far the most popular. Even since Rule 506C came out, it hasn't been as popular as the SEC thought it was going to be. And people are still relying on 506B. So it's an important rule. Are there some filings required? Yes, we have to do the filings with the SEC and the state securities agencies. There are no limit on the number of accredited investors you can bring in, but all of your investors have to be verified. So they have to go, you as the syndicator have to have a reasonable assurance that those investors are accredited at the time they invest with you. And what that really means is within the last 90 days prior to making the investment. So you can't let somebody go and get verified with a third-party verification company, then come back to you with a letter that's 6 months old. You'd have to ask them to get that updated. They could also bring in a letter from their own CPA, their own attorney, their own registered investment advisor, somebody with a license, or you could even look at their financials yourself. The risk with looking at the financials yourself is that if you're not set up to do that, all of a sudden you become responsible for safeguarding their financial information from cyber threats. You know, so if they're going to email stuff to you and their financial statements and all that stuff, or their tax returns, you've got a big burden there with making sure that you're safeguarding that information. So unless you're actually in the mortgage brokerage business and you have ways to do that, I would not recommend that for you unless you're meeting with people face to face. You can look at it, you can certify it yourself. So remember, your obligation is to have a reasonable assurance that everybody is accredited at the time they invest or within 90 days of that. For the Rule 506B, there isn't such a requirement. The investors can actually read the definition and self-certify that they meet those qualifications. Your only obligation for Rule 506B is to, if you have contrary information about them, or you know that they're not being truthful to you, then you would have an obligation not to accept their investment. But that's not, that you can take them at your word absent any contrary information. And the same thing with the non-accredited. They're going to certify to you before they invest in a full Rule 506B offering that they are actually, sophisticated enough, and they're going to actually tell you in their own words why they think they're sophisticated enough to be in your deal. They're going to read the definition and explain to you why they think that applies to them. So in Rule 506C, though, you can't even take even one non-accredited investor. Can't accept any non-accredited investors. And if you do 506C, you can freely advertise. You can advertise in the newspaper, on the internet. I hear a lot of Rule 506C ads on the radio. So you could advertise that way, podcasts, any means that you want, as long as your ads are legal, truthful, not misleading. So that's always going to be a factor in any advertising you do for any securities offering, is that you have to be extremely careful of the anti-fraud statutes, which apply anytime anything you say is misleading, is a misrepresentation, could be interpreted differently than what it really means. So you've got to be very, very careful. And this is why you really need to have a securities attorney reviewing your website, anything that you're sending to investors, to make sure that you are not making promises that are going to be part of those anti-fraud statutes that are going to get you in trouble later, or that are going to be red flags for securities agencies. All right, so in the Rule 506C, you don't have to have any pre-existing relationship, so you can freely advertise. So that's that's a big deal. You can do that. The only reason that you would go to a Rule 506C offering is when you run out of people that you already know and people that you already have pre-existing substantive relationships with. But the way not to run out of them is to continue to make them, continue to create pre-existing substantive relationships. So what does that mean? All right, pre-existing means it predates the offering. So it predates the time that the offering was contemplated or current. And substantive means that you have had a conversation about the investor suitability to be in your offering. So conversation about their suitability, we're going to talk about that in a little bit. All right, so how do you comply with all of that? One step at a time. Select your business model, choose your securities exemption, meet investors, develop relationships, pitch deals, raise money, close deals. That's your roadmap right there to how you're going to do this. So what should be in your investor marketing plan? So now that we kind of understand the basics of the securities laws we have to follow, what we're really trying to do here is to set up a bunch of those pre-existing substantive relationships with investors so that when you have a deal, you can freely talk to your investors about that deal. And as long as you've done this, taken the steps to have those pre-existing substantive relationships, you can advertise to those investors. But you have to make sure that you have a record-keeping system to show how you did that. How did you establish that relationship? So the best way to do that is to have an investor marketing plan. And there's 3 things that are completely essential to be in your investor marketing plan. Number 1, how are you going to meet investors? 2, what you can say to investors and when to say it. And 3, how you're going to get investors to remember you. Because you might meet somebody at an event 6 months or a year before you have a deal. And if you haven't kept in touch with them or had some meaningful conversations with them at some point, you're not going to be able to have a conversation with them in the future because they're not going to remember who you are. All right, so let's talk about how you're going to meet people. Conferences, okay? Networking events are a really great way for you to meet people. Attend as many conferences as you can. Local, national, regional, doesn't matter. If you want to be a big fish in a small pond, then go to your local events. Go to your Chamber of Commerce, go to local philanthropic events, because you might be one of the few real estate investors in the room. If you want to just meet as many people as you can possibly meet, go to as many of the big nationwide events as you can and network and gather information, meet people, have lunch, have dinner, have follow-ups, do that. Okay. Another place that you can meet people on a regular basis is at your local real estate investment association meetings. And that's a good place to stay in the company of like-minded people and making sure that you stay motivated, learning new techniques all the time, and meeting people that could become important partners for you down the road. So chance meetings and introductions are another way that you're going to meet people. You could meet someone while you're sitting next to them on a plane or at some event like a Chamber of Commerce or something like that, or just, in a coffee shop, or somebody could introduce you to somebody, and that could become an important source of investors for you. Gatherings of family and friends. You're talking to your family and friends about what you're doing, getting them excited about what you're doing. So you think about who you know right now and make a list of your family, your friends, past clients, colleagues, people who might know people. Maybe you know somebody who's a bigwig in your town, or they're connected to some local country clubs or yacht clubs. Maybe you can join some of those places yourself. Attend philanthropic events, because a lot of people that are wealthy like to donate their time. So make a list of all the people that you know now, and then we're going to teach you in a little bit what you can start saying to those people. All right, so educational events that you organize. You can hold your own educational events on a local scale. You could go rent a room in a hotel, and you could invite people to come for a 1 or 2 hour educational session on how real estate syndicate works, or any other topic. We'll give you a couple topics in a few minutes, but just kind of walk them through the process, explain how it works. These are generic educational events, because until you've actually developed that relationship, you can't pitch your deals unless you're doing Rule 506C offerings. Then your educational event would be much different. If you're doing 506C offerings, you could hold an event in a hotel and you could pitch your deal, and it could be all about the pitch. If you're doing 506B offerings, then you need to provide them with generic educational information, and then use that as a way to introduce yourself to more people, showcase your experience, portray yourself as an expert, and then follow up with them later and develop the relationship. So what kind of educational events can you do? You could do webinars, podcasts, live events. What kind of topics could you teach? How syndication works? Real estate versus the stock market is always a good one, because this is where people are putting their money now if they're not investing in real estate. And so if you can show them some historic trends on what's the difference between real estate versus the stock market, then they might be more interested in investing with you, or investing part of their portfolio with you. What's an emerging market? So those are just some simple ideas. There's lots more. All right, so what other ways might you advertise for investors? Well, if you're doing 506B offerings, you have to be extremely careful about social media. But if you're doing 506C offerings, then these are some viable sources for you. Is Facebook, LinkedIn, BiggerPockets, and those kinds of social networking events. You can have a website. So you're going to use it two different ways. If you have a Rule 506B offering, you're going to use it as more of a company brochure about us, who we are, what we do, what we look for. Remember when we talked about your business plan? That's what you'd put on your website. If you're going to be doing 506C offerings, then you could actually have a website set up where you actually show specific information about your deals. If you're doing 506B, then you would have to have your deals behind a password protected page, and you would have to carefully control who has access to that password and make sure that you already have pre-existing relationships with them before you allow them to review your deals. So what would you do on your website if you wanted to use it to attract new investors? You can have giveaways. Now, you can do this on either whether you're doing 506B or 506C, you can do all the things that I'm telling you on this page. You can have giveaways. Why would people give you their contact information that found you on the internet? Because you're giving them something that they want for free. You can do a blog where you provide information to them and they find it of value and they would give you their contact information to keep receiving your blog. You can write a book. It's a little tough to do that. We do monthly teleseminars with our law firm, and they're actually all available on our website. We have over 2 years of 1 hour monthly teleseminars recorded on our website, and there's one of them about how to write a book. So you might want to check that out if that's something you're interested in. You can do videos, information videos, and things like that. Maybe you're going to do those live educational events and actually record them. And now you could make those available to people on the internet if you wanted to, as long as you're not pitching deals. Okay, other people's stuff. There are, probably some of your real estate gurus, I know a couple, that would allow you to affiliate with them or to join some affiliate program with them where they might even allow you to promote some of their stuff. So they've already created some home study courses and things like that that they might allow you to promote for them that would boost your credibility in your investor's eyes. So what to say and when to say it. Now, this is kind of this is the second element of your investor marketing plan. Remember, first was how to meet investors. Second is what to say and when to say it. All right, so think of in developing investor relationships, it's like dating. There's a progression in a dating relationship, and there's an objective at each point in the relationship. So first you're going to meet somebody. Maybe you meet them at a bar. Maybe you meet them at a family gathering. Maybe somebody introduces you, and if you are attracted to that person, then you want to say something to them to pique their interest. It's your pickup line, right? Think of it as your pickup line. It's a little cheesy, but there's a lot of different things that we call that. But that's your first objective, is to pique their interest. Why? So you can schedule a date. All right, so a follow-up meeting, whether your follow-up meeting is going to be on the phone or maybe it's going to be live in person. Either way, you want to do that. What's your objective at that first date? Well, if you're actually in a dating relationship, your first objective at that date is to find out if you have common interests, if you like each other, if you want to, maybe take it a step further and meet or start, having further conversations. Same thing with your investors. Your first date with them is not for you to blab about your company and all the great things it does. It's to get to know them, ask them what they do, ask them what they're looking for, make sure that, it's compatible with what you have to offer. All right. And then only after you've gone through that, and I would think that, in a dating relationship, you're not going to have a first date and then propose marriage. Because if you do, somebody's just going to think you're a freak and they're never going to want to talk to you again. And it's the same thing with investors. They don't want to meet you once and then have you making investment offers to them. They need to see that you're for real. They need to see your presence out in the marketplace. They need to meet you again and again and, have a way to know that you're a legitimate business. And so the more of these things that we're talking about here that you can do, have a website, have follow-up meetings with them. If they're in your town, do them face-to-face. I heard a guy on the news one day say, my brother makes millions of dollars by going to lunch. And I thought that was great because his brother was clearly in the financial industry and raising money from investors. And, he was just developing relationships. That's all. One of the most successful syndicators that I know is Sam Freshman. And he was on our webinar at one point, or our teleseminar, and he said, I just joined every single group I could possibly join, and I kept going. And he's got more investors than he knows what to do with. So, that's what you can do too. You've just got to be a social butterfly. So your proposal to your investors, when you get to that point, is to pitch the deal. So that's where you've got a sufficient substantive relationship with them. Now you can start pitching deals to them freely. All right. So what's going to help you do all this? How about if you had some script where you knew exactly what to say, where you spent some time thinking about what you were going to say, what your pickup line was going to be, what was going to be your conversation where you're determining suitability, which can be a little uncomfortable, and what you're going to say when you're making your proposal. That would help you a lot. So let's think about what those things might look like. So for your first meeting, you need a magic statement, pickup line, elevator pitch. You can call it whatever you want, but you need something that's, pithy, it's short, you don't stumble on it when you're talking about it, and you need to be able to tell people this is what I do. And what's the objective? Meet and intrigue. So, and how is that even going to come out? Because you're going to be sitting next to somebody you've never met before, and in a few minutes, you're going to say, what do you do? Or they're going to ask you, what do you do? You've got to be able to answer that question. That's the whole purpose of that magic statement. Okay, so it needs to be compelling. It needs to invite further conversation. So our example, I'll give you the example of what ours is. We help people who are raising money from private investors stay out of jail. Is that compelling? Would you maybe ask a follow-up question? What, really? Like, I can go to jail if I don't do this right? How do you do that? Well, we provide legal documents, business advice, and marketing materials, and we teach them how to comply with securities laws. Okay? So if I was at a real estate event, I'd say we teach you how to comply with securities laws. So you're going to change the wording for your context, but you need to come up with something like that. All right, so what's going to be in your follow-up meeting? What do you say on the first date? It's all about them. You're asking questions all about them. When are you going to do it? You're going to schedule either a follow-up call if you're not local to them. Maybe you went to an event, you met people from a different state. You're just going to schedule a follow-up call. If they're local to where you live, then you're going to schedule a follow-up meeting. And then your objective during that call is to determine their suitability. Now we're going to talk about how you're going to do that. First and foremost, before you start talking about legal suitability, make sure you like the person. Okay, make sure that you're compatible. Look for things that you have common interests in. I did talk to somebody who's raised a lot of money very recently. He's been in business for 25 years, and he said, I just look at people and we try to find something that we have in common. And once you do that, you can become friends, and friends will invest with you for life. The other thing is that now you've got to determine their legal suitability. Okay, and this is, the SEC has determined that these are the kinds of questions that you need to ask. If you want more information about this, go to our website at syndicationattorneys.com, and there is an article there called Determining Suitability. Find that article and read it. It's just a couple of pages, but it actually has a link to the questions that you could ask your investors during this follow-up meeting. So I would encourage you to get that and review it and start doing that. And so what do you ask about? Past investments, what's their education, are they accredited, are they not accredited, are they sophisticated, and what are their financial goals? And you have really one objective here: is this person a match for you? It's the same thing as if you were on a date with them. Common interest, compatibility, what's their future goals for having a family, not having a family, career goals, things like that. You'd want to know that, and you'd be in your mind kind of figuring out whether this is somebody you want to have a further relationship with, because they either are or not compatible with you. So this is great. See, you not only get investor advice, you get dating advice on this show. So I hope it's helpful. So when you have a deal, all right, now that you've gone through that with your investors, you have a substantive pre-existing relationship. And if it predates when you have the offer, then now you can start showing them a deal. If you just met somebody and you already have a deal and you're trying to raise money for it and you're closing in a couple weeks, and you just met somebody and you haven't had that suitability conversation yet, they're not ready for you to start pitching deals to them. So you really need to go through and have that suitability conversation with them. The SEC actually said in the article that you're going to read about on the article on our website, they actually said that it's more about the quality of the relationship than the quantity of time. Okay, so it's not, I mean, some people say there's a, rule of thumb, 3 touches in 30 days. That's all good stuff, and it's a great idea, but it's not necessarily what you need. And it's not the only thing you need. You need to have that suitability conversation, and then at that point, once you figure out that they're suitable, now you can start talking to them, and that could happen in a shorter period of time. So when you got a deal, pitch it. And then how are you going to pitch it? We'll talk about that in a little bit. So the third thing in your investor marketing plan is that you have to, figure out how you're going to get your investors to remember you. So now we've met investors. We know how to meet investors. We know what to say to them along the way. But what do we do to keep them, keep ourselves top of mind so that they are going to be ready and remember us when we call and say, hey, we do have a deal. We talked about it a while back. You've been getting our stuff. We'd like to have you invest with us. So this is where you really need professional grade marketing materials and follow-up systems. This is probably the hardest thing for people to set up. In fact, we found that we kept telling our clients, you need this, you need this, you need this. We told them this for 8 years, and finally we figured out that they couldn't find it anywhere in the market. We couldn't find it anywhere in the market. We couldn't find what they needed, so we created our own division that actually does it. So we have professional editors, graphic designers that can help with the marketing materials you need, just because we were having such a hard time finding it ourselves. So what kind of marketing materials are we talking about? Okay, we've already talked about your investor marketing plan. There's actually a template for that on our website. If you go to the online store, you can look at that and see that investor marketing plan template. You could purchase it there if you want, but I'm going to tell you how you could get it for free. You have to develop your magic statement. And that's something that we would be able to help you with. And I'll tell you again how we can do that in a little while. Pitch deck. You're going to need a pitch deck to be able to pitch your deals to your investors. And you need a website. We've already talked about all of those things. Right? What else might you need that we haven't talked about yet? Well, you need to have a branded company and a business card. So during that first meeting, you got to be able to hand somebody your contact information that they can keep, and so they can pull it up and remember who you are, from when you call them and do that follow-up meeting. So what I like to say is you should have a business name that's easy to pronounce and spell. Okay, try to stay away from Latin things that mean something to you but nobody else, or foreign words, unless you're dealing with a foreign audience that's going to understand that word and those words. So plain and simple things that speak about what you do, or they mean something to you, but they should be something that is somewhat compelling if possible, but at least easy to pronounce and spell. Okay, so not really long names. Keep them short, three, 4 words at the most. And then you need to have a compelling title. Don't name yourself president, managing member, managing partner, because those are the most boring things you could possibly be, and nobody will ever ask you what that means. All right, if you want to be something else, you can be chief strategist. You can be, which by the way is what my husband calls himself for our firm. You can be a fund manager, a real estate fund manager, director of acquisitions, something that's a little more compelling. So try to think about that when you're doing your business cards. All right, and company brochure. So a company brochure is really just like your website, but it's on paper. And it's going to be in a nice brochure format with some color graphics, professionally designed, so that you can hand that to somebody. If you have a meeting with somebody face-to-face, you want to take that with you, hand it to them so that they can take it home and show it to their significant other. And you always want to give them something so they have something in hand, so they don't have to go take a further step and look at your website. They will go look at your website. So when they do go look at your website, you really need to make sure that your website and your company brochure have the same style and theme and color schemes and same logos. And so again, think about professional design for these things. The more professional you make yourself look, the higher net worth individuals you will attract, and the faster you will be able to raise money. I have seen this happen again and again with my clients over the years. Property overview, you're usually going to get a template for that from, maybe the person that you're learning to buy whatever that asset class is, whoever your real estate trainer is, you're going to be getting that from them. We also have one that we've had professionally designed that you could purchase on our website, or again, we'll show you how you could get it for free. One-pagers, you really want one-page teasers that you can send to people for your property overview, for your company brochure, maybe even for your business plan. The other thing that you're going to need is some kind of follow-up system. So once you've met somebody for the first time, you've had that first date, what are you going to do to keep in contact with them? You need to have a newsletter or a blog or something where you're touching them on a regular basis. Talk to your marketing people about how frequently you think you should be touching people. Provide information of value, educational information in each one. If you set up a newsletter or some kind of a drip system where you can have 12 to 20 months of contact with someone. It might take that long for them to actually want to invest with you, but if they see you every month for 12 to 20 months, then they're going to start realizing that you're in this for the long haul, you're not a fly-by-night, and they're going to take you more seriously. So that's your drip system. And it's hard to write these things, but they don't have to be long. It can just be one page. In fact, if I get a newsletter that's going to take me more than 5 minutes to read, I don't open it. I don't have time. So if it's one, quick article that I can read, I will read it and I will be happy to have it, and I won't unsubscribe to those people. Okay, and then so this is an SEC rule. You have to have a record-keeping system to show how and when you developed that substantive relationship, showing that it predated your offer. And then you also want to keep track of how you contacted those people over time and how that's worked out for you and what they've said, what are the answers to those suitability questions, all of those things. If you keep all of that in your database, then you're going to be in really good shape if you ever were to get a letter from a securities regulator asking you how you complied with that exemption. Those exemptions, Rule 506B and Rule 506C, are self-executing. That means that the burden is on you to prove how you followed the exemption. So the only way that you can do that is to have a detailed record-keeping system where you've kept track of all of that, and you can show them, oh, these are the people that I met, here's where I met them, here's how I had the suitability conversation, here's the questions that I asked them, here's how I followed up with them afterwards, so that you don't get in trouble for generally soliciting people that you don't have pre-existing relationships with, or doing things that you're not supposed to be doing in the securities world. So what we can do for you, we can prepare your securities offering documents. We do that all day long. We have staff that does that. There's several attorneys in our office, several paralegals, and support staff. We have investor marketing materials that we can prepare for you. You can look at those in our website and our online store. And we offer free consultations. You can schedule that at our website, syndicationattorneys.com. We also have a Quick Start Retainer program, and this is where you can get some free stuff from us. One of the things that you can get with the Quick Start Retainer is our clients-only Facebook group. What we are building a whole training program around this very presentation that I just gave to you to help you develop your own investor marketing plan and creating the best possible means of success for you. So our clients-only Facebook group, we're going to start doing live training twice a month on developing an investor marketing plan. And we'll be able to have some Q&A with that as well. But with our Quick Start Retainer, you also get up to 3 hours of legal consultations, and so that you can use those. You can join the Facebook group and the live training, but then you can have one-on-one calls with us, or you can have us review the materials that you're generating, or you can talk to us about any questions you have. Once you're a client, we will give you the investor marketing plan template for free, and we will also give you the property package template for free, and you can get both of those. So we're really trying to fill a gap that we've seen with all of our clients, where even the ones that have been doing this for a long time are still struggling to find investors when they find deals. They're making compromising decisions. We don't want to see them do that. It's not good for them. It's not good for their investors. It's not good for their long-term business. We want to help you get past that so you don't have to worry about that, so you can do bigger deals, better deals, more deals. So the one thing that you can do right now is on our website are the free monthly webinars that you can listen to. There's 25 of them posted there. There's a ton of articles that I've written that are 1 to 2 pages long. There's like 20 of them on there. There's also read the frequently asked questions, and there's some podcasts. And the exciting thing, of course, is we've got the book coming out. So if you want to, know more about the book or anything like that, all those things, you can email us at info@syndicationattorneys.com, and you can ask to be put on the list. But the last thing that I want to tell you about
10 o'clock.
is that we are going to have an investor sales and marketing workshop. It's going to be a 3-day workshop. We're still working out the details on when it's going to be, but we're looking at November. And the whole objective is that we want you to walk away from that workshop in hand, your business plan, your marketing plan, your scripts, those 3 things that you're going to need in order to be able to to approach investors successfully and to build that foundation on that database of prospective investors. So you got all the investors you need when you got a deal. So that's all I have, Chris. If we take some questions.
Kim, that was phenomenal. I definitely learned a lot of great info from you. Very excited about that book. Can't wait for that. We do have 15 more minutes, so we have a couple questions for you. One question, will that book be on audio as well?
I don't know how long it's going to take us to produce that. So, this is my first time producing a book. We're just getting the print version. We're going to do a Kindle and print version right away. But definitely that's been suggested to me, and I like audiobooks myself. So that's definitely a possibility.
Very good. Next question. Is it better to use a third-party verification company? I'm assuming this is for a 506C.
That's right. If you're going to do 506C offerings, it's probably better to do to absolutely use the third-party verification company. There's several of them out there that can help you, and we can direct you to some of them too.
Very good. With a rule of a 506B, if someone self-certifies and it turns out that they are not accredited and you already have 35 non-accredited investors, what might the SEC do?
Okay, so this was with a 506B offering?
Yes, so this is with the 506B offering, and that you are interviewing a potential investor, and it turns out that they are not accredited, and you may have thought that they were, and you are already at your max of 35 non-accredited investors, sophisticated investors. What might the SEC do if they find out, or if that one accredited or that one investor ends up not being accredited and sophisticated, and they're in the deal?
Okay, so you have 2 options here. One is not a good option, and one is a great option. One option is just, hope they don't find out, but they could take away your entire exemption and say you're not entitled to this at all, so therefore you've sold illegal securities, you've sold unregistered securities, and you're not entitled to an exemption, and that would be bad. The other option is that one of the definitions of an accredited investor is somebody who's involved in management. So you could bring that person in as a member of your management team and give them a small piece of your management entity and give them some other responsibilities besides just being a passive investor, so that they then could qualify as part of your management team and qualify as an accredited investor that way.
Very interesting. This is great info, with the question is will these slides be available to the attendees? Is there any way they can email you or get in contact with you?
Yeah, absolutely. If you want a copy of the slides, please email info@syndicationattorneys.com, and we'd be happy to provide a copy of these.
Very good. Last question. Does the SEC regularly police offerings to make sure that pre-existing relationships existed prior to sharing the offering?
How this is going to come about is they're not going to be looking at your offering unless somebody starts complaining. So there's two ways you could get attacked. One is that the regulators could actually get involved because somebody complained. And people can complain either to the SEC or they can complain to the state securities regulators in the state where they live and say, hey, this guy didn't do this or didn't do that. So, or I didn't have a relationship with them and they let me invest and I'm not accredited, or, whatever they want to say. So you've got to be careful of that, because that could come from a regulator. But here's the other place it could come is from a disgruntled investor. And that's where I've seen it come more, is that disgruntled investor will, and that's going to happen either for a couple of reasons. It could happen because the deal stinks and they're not making any money, or it could happen because something happened in their life and they want their money back and you can't give it to them because it's tied up in the property. That's the most likely scenario. And so they get angry and they go to their attorney, and their attorney, hey, my, poor 73-year-old, senior citizen client just wants his life savings back, and these big bad people won't give it back. And, so they're going to start making your life hell, and they're going to look at all the things you did, and they're going to start asking all those questions. How did you meet them? When did you, how did you find out about this deal? How, do you have a substantive relationship with them before they asked you to invest? That kind of thing. So that's where it's going to come about. It's not going to be that somebody's going to be auditing your deal unless there's a problem. And then that's when it all kind of, everything goes haywire.
Very good. Very good. 3 more questions. Can you give more information on your quick retainer program, price, etc.?
It's $1,000 and it gives you up to 3 hours of legal advice. My normal hourly rates are $5.95 an hour, so it's a really significant discount. And then it gives you access to the clients only Facebook page. It also gives you a copy of the investor marketing plan template and the property package template. And just so we make this totally enticable. If you do a syndication within 12 months of initiating that agreement, we're going to give you that credit of $1,000 towards your lump sum syndication fee.
Very good. That sounds great. That's a great deal right there.
Yeah, the whole point is that we really want to help people get from where you are today to having the confidence and the ability to go out and raise all the money that you need. And we don't want you as a client for life, just like you don't want investors. I mean, we don't want you as a client one time. We want you as a client for life. Just like you want your investors as investors for life. We want the same thing, and we want to help and be part of your company's growth. So, we think we can help you do that. And this is our way to give you like that kind of push start. And once you master these skills, you're going to be golden.
Yes, definitely. It's all about relationships. It's very important.
Absolutely.
Any recommendations for a CRM to help stay compliant?
We used Insightly. It's like the word insight with an LY. It's a Google app. Our firm used that for a long time, and it worked really well for us. I think it's even free for 2 people. Of course, you're going to get into a point where you want some more advanced stuff and you might want to pay for it. But it's a good starter CRM. There's some out there that are fantastic that are, they have a ton of bells and whistles and, stuff in there that you might not be able to figure out and use right away. So, start small. Any CRM that you get is going to allow you to export the data into a new one if you decide you want to step up and you're ready for something that's a little more robust.
Very good. Very good. Is that the same process to put on a management team if outside person helps raising money? I think this question is kind of geared towards more the second question about. Let me scroll up here. About having an investor who you thought was accredited and he's not accredited, and he's sophisticated, and bringing him on. Is it the same process to put on a management team?
Yeah. So I have a lot of clients that will bring in people who know people into their management team in order to have them help them raise the money. So thinking back to the securities compliance, the exemption applies to the issuer of the securities. So that's what the SEC calls people who sell securities, as the issuer of those securities. So the issuer is the one who's entitled to that exemption. So you have to pay close attention when we're filing that Form D there's a form we file with the SEC called a Form D, and we have to be careful about who we name as the issuer. So typically we'll name the entire investment LLC that we've created that's going to take title of the property, sell interest to investors. If that entity is the one that's named as the issuer, then any member within that issuer could refer people to your deal and still be entitled to the issuer exemption. Most people will bring them in as a member of the management team and allow them to come in that way. The real sticking point here is not how you bring them in, it's how you compensate them. Because it's illegal currently to pay finders for bringing investors to your deal unless they have a securities license. And so that's where you've got to be super careful. You can't pay independent contractors and third parties. You really have to bring them in as part of the management team. And technically the rule is that they have to have a role in management other than raising money, and the amount of money that you're paying them is that you're compensating them is unrelated to the amount of money that they've brought to the deal. So it's a little bit complicated. There is an article on our website called Paying Finders Fees. I would encourage you to read that. There's also some pending legislation, hopefully it'll go somewhere, but this has been proposed a few times before that would allow people to act as finders. Any of your listeners that are in California, California actually has a finder's law. There's actually two ways in California that people can get paid that are not registered broker-dealers, and one is to register as a finder, and it's just kind of an application and a fee process. But it has to be for California deals. And then the other way is California actually has an exemption where real estate brokers who refer money to a real estate deal in California can actually be paid a finder's fee or a commission. So other than that, around the rest of the country, you have to have a securities license in order to earn a commission. So, just make sure that you're going to come in, you're going to provide some meaningful participation in something other than just bringing in investors. Everyone in management should have a job of raising money. Everybody in management gets compensated for all their other jobs besides raising money.
Very good. All right, last question. We have 4 more minutes. The refund of the quick start price, if we do a syndication, how much does a syndication usually cost in the first place for a 506B or C?
Okay, so they can start as low as $8,500. And $8,500 is the low end. They can go all the way up to 15. It depends a lot of it depends on what the qualifications of your investors are. You are not absolutely required to have a private placement memorandum if all of your investors are accredited, either with a 506B or a 506C offering. However, the caveat there is that the private placement memorandum is your insurance policy. So it protects you from your investors because it's the place where we tell them all the different things that could go horribly wrong with the deal and how come they might not make a return on their investment or all of their money back or any of their money back. And if one of those things happened that we told them about in the beginning and they signed off on it and they subscribed and they agreed that they were willing to accept those risks, they've assumed those risks and they can't come back on you later unless you did something illegal or willfully wrong to make it happen. So it's an insurance policy and a protection for you. But technically, if you had an accredited only offering, and we would suggest no more than 4 or 5 investors whom you know very, very well, you could do it for $8,500. If you're going to do, if you need a PPM, those usually start around $12,500. And then, you may need some extra things on top of that, depending on what your lender requires and what other things that you already have in place.
Very nice. Very good. Well, Kim, a wealth of knowledge you gave us today during your presentation. I think all of the attendees definitely will be reaching out, had great questions that you answered. Just to finalize everything and sum everything up, the best way to reach you is info@syndicationattorneys.com.
That's right. Or you can go to our website directly at syndicationattorneys.com. and you can click a button and schedule an appointment with Charlene Standridge. She's our law clerk, and she will get you set up with whatever you need. And then if we need to have a conversation further with me, then she'll coordinate that.
Very good, Kim. Well, thank you very much for your time. Again, wealth of knowledge that we earned today. I hope you have a wonderful Saturday, and thank you again.
Thank you so much.
All right.
It was a great event.
Great. Take care. All right, guys, I hope, ladies and gentlemen, I hope everyone got a wealth of knowledge from that. Definitely very important information. Definitely, I am going to go back and take another look at it. Do not forget our iPad drawing right here. We have 3 iPads we will be giving away, and this is how you get entry in the drawing to hopefully win the iPad. Register for the 2020 Summit. Go to nextmfin.com. You'll get 1 entry by registering for the next 2020 Summit.